Picture this. It is Tuesday morning, the coffee is still brewing, and somewhere in Cupertino, a bunch of executives are probably high, fiving each other because Apple just did something no company in the history of the stock market has ever done before. For one brief, shining, absolutely electric moment, Apple touched a $5 trillion market capitalization. $5 trillion. That is a number so large it barely means anything to the human brain anymore. Kind of like trying to picture how many grains of sand are on a beach. Except this beach is made entirely of iPhones, and every single grain is worth more than most countries produce in a year. And then, almost as if the universe has a sense of humor, within days of hitting that historic milestone, the stock turned around and took a 7% nosedive after a weaker than expected guidance. From the company's own earnings call, talk about a plot twist. One day you are throwing a party for reaching a number that sounds made up, and a few days later, you are explaining to shareholders why the champagne needs to go back in the fridge for now. If this was a movie, the trailer would practically write itself. Coming this fall, the rise and the wobble, one company, one impossible number, and one guidance call that changed everything. So today we are diving deep into this entire roller coaster. We are going to talk about how Apple got to $5 trillion. In the first place, how it briefly leapfrogged NVIDIA to become the single most valuable company on planet Earth, why the stock then proceeded to give back a chunk of those gains almost immediately, and what this entire saga tells us about where the technology sector, and honestly, the broader stock market might be headed from here. Stick around, because there is a genuinely fascinating story buried in these numbers. And by the end of this video, you are going to understand exactly what happened and why, without needing a finance degree or a bottle of aspirin. Quick note before we get moving. If you are new around here, welcome aboard. This channel exists to break down exactly what is happening in the markets, in a way that actually makes sense, without the jargon, without the panic, and without pretending anybody has a crystal ball, because nobody does, not even the folks with the flashy graphics and the booming sound effects on financial television. If that sounds like your kind of channel, go ahead and hit that subscribe button, because we cover stories exactly like this one every single week. And the market never seems to run out of plot twists to hand us. All right, let us rewind the tape a little bit and set the stage properly. For most of this year, Apple has been on an absolute tear. Shares climbed roughly 25% since the start of the year, which on its own is a genuinely strong return for a company, already worth several $1 trillion before this rally even started. Think about that for a second. It is one thing for a scrappy little startup to double or triple in value in a single year. It happens all the time, and honestly, half the time it is more luck than skill. But when a company already worth close to $4 trillion manages to tack on another 25%, that is an entirely different kind of achievement. Because you are talking about adding the equivalent of several entire Fortune 500 companies' worth of value in the span of a few months. So what exactly was fueling this rally? A few things were working together at once, kind of like ingredients in a recipe, finally coming together at just the right moment. Investors had grown increasingly confident about Apple's services business, which includes everything from the App Store to Apple Music, to iCloud storage subscriptions, all of which tend to carry much fatter profit margins than selling a physical piece of hardware. There was also renewed enthusiasm about the iPhone lineup, with strong demand signals coming out of the supply chain, suggesting that customers were still very much willing to open their wallets for the newest models, even at prices that make your average person wince just a little bit at the checkout counter. And then there was the broader excitement, swirling around artificial intelligence, integration into Apple's devices, because, let us be honest, in this particular market environment, if a company even whispers the letters A and I near a press release, investors tend to perk up like a dog hearing the sound of a treat bag opening. Whether or not Apple's specific approach to artificial intelligence ends up being the market-leading version of that, technology is honestly still up for debate among analysts. But the market rewarded the anticipation anyway, which happens more often in this business than most people would like to admit. All of this momentum came to a head on that now famous Tuesday, when Apple's market capitalization briefly crossed the $5 trillion threshold for the very first time in the company's history. And here is the part that made the whole story even juicier. Because just one day earlier, Apple had actually overtaken Nvidia to reclaim the title of the most valuable, publicly traded company in the entire world. If you have been paying attention to markets over the last couple of years, you know that Nvidia has basically been sitting on that throne like a king who refuses to leave the castle, riding an absolutely historic wave, thanks to the artificial intelligence chip boom. For Apple to swoop in and knock Nvidia off the top spot, even briefly, felt a little bit like watching an underdog boxer land. A surprise punch in the final round of a fight everyone assumed was already decided. Now, before you picture Tim Cook literally moonwalking through the halls of Apple Park with a giant foam finger, let us be clear about something important. This kind of leapfrogging at the very top of the market capitalization leaderboard tends to happen more often than people realize, and it usually does not last very long. Kind of like musical chairs at a birthday party, where the music keeps stopping and starting every few seconds. Nvidia and Apple have been trading blows for the title of most valuable company for a while now, and honestly, so has Microsoft, depending on which particular week you happen to check. It is less a permanent coronation and more a friendly, extremely expensive game of leapfrog between 3 or 4 absolute giants of the corporate world. But regardless of how temporary the title might be, hitting $5 trillion is still a genuinely historic milestone, and it deserves its moment in the spotlight. Kind of like when your friend finally beats their personal record at the gym. Sure, someone else might beat that same number next week, but for that one glorious moment, it is worth celebrating properly. Okay, so here comes the twist in our story, the part where the confetti cannons get put away rather abruptly. Just days after this historic milestone, Apple released its latest earnings report, and while the actual numbers themselves were not necessarily catastrophic, the forward-looking guidance that the company provided came in weaker than what analysts and investors had been expecting. And in this particular market, in this particular era of investing, guidance tends to matter just as much, if not more, than the actual results sitting right in front of you. Here is an analogy that might help make sense of why guidance matters so much. Imagine you go on a first date, and the date itself goes perfectly fine. Good conversation, nice restaurant, everybody has a decent time. But then, right at the end of the night, your date casually mentions that they are actually moving to another country in 3 weeks and are not sure when they will be back. Suddenly, that perfectly fine date starts feeling a lot less exciting, right? The present moment was fine, but the outlook completely changed how you feel about the whole situation. That is essentially what happened with Apple's guidance. The current quarter looked fine on paper, but the company's own outlook for what comes next introduced enough uncertainty that investors decided to hit the brakes, and hit them fairly hard. The stock proceeded to drop, roughly 7% in the trading sessions that followed, which might not sound like a massive number if you are used to hearing about penny stocks, doubling or tripling in a single afternoon, but remember, we are talking about a company worth trillions of dollars here. A 7% move on a company that size represents an absolutely staggering amount of actual dollar value, evaporating from the market in a remarkably short window of time. We are talking about hundreds of billions of dollars in market value disappearing, which, just to put that in perspective, is more than the entire market capitalization of plenty of well-known companies you could name off the top of your head. So what exactly spooked investors so badly in that guidance? A few specific concerns seem to have bubbled up to the surface. There were worries about supply constraints, potentially limiting how many of the newest devices Apple can actually manufacture and ship in the coming months, which is a strange kind of problem to have because on one hand, it suggests demand is strong enough that supply cannot keep up. But on the other hand, investors generally hate hearing the word constraint in any earnings call because it introduces a level of unpredictability that Wall Street absolutely despises. There were also broader concerns about margin pressure, about component costs, and about whether the services business, which has been such a bright spot in recent quarters, can continue growing at the same blistering pace it has managed to sustain recently. Let us take a moment here to appreciate just how wild this entire sequence of events actually is. When you lay it all out chronologically, on one single Tuesday, Apple becomes the most valuable company that has ever existed, in the history of stock markets, briefly dethroning Nvidia in the process. Investors are cheering, financial media is running, breathless headlines somewhere. A junior analyst is probably updating their spreadsheet models at 2 in the morning, just trying to keep up. And then, before the champagne has even gone flat, the very same company turns around and hands investors a guidance report that wipes out a meaningful chunk of that freshly minted trillion-dollar valuation. It is like watching someone win the lottery on a Tuesday and then get a parking ticket on Thursday that somehow costs almost as much as the winnings. The scale is obviously different, but the emotional whiplash is remarkably similar. This whole episode actually teaches us something really important about how the stock market thinks, or perhaps more accurately, how the stock market feels, because despite what anyone tells you about efficient markets and rational pricing, there is a whole lot of emotion baked into these daily swings. The market does not just care about what a company earned last quarter. It cares intensely about the story that company is telling about its future. And the moment that story gets even slightly less optimistic, the market can react with a swiftness and a violence that seems almost disproportionate to the actual change in the underlying business. Think about it from the perspective of a company like Apple. This is not some scrappy startup burning through venture capital and hoping to figure out a business model someday. This is one of the most profitable, most cash-rich, most operationally sophisticated companies that has ever existed on planet Earth. The actual fundamentals of the business did not suddenly crumble overnight. Just because guidance came in a little softer than expected, iPhones are still selling, services revenue is still growing. The company still has an absolutely enormous and loyal customer base that shows no signs of jumping ship to a different ecosystem anytime soon. But the market, in its infinite and occasionally irrational wisdom, decided that even a modest disappointment in guidance deserved a swift and fairly brutal punishment. This connects to a broader theme we have talked about on this channel before, which is that in the current market environment, expectations have become almost as important as actual results. When a stock is trading at a premium valuation, which Apple certainly was heading into this earnings report, given its historic run higher, the market essentially prices in a certain level of perfection. Any hint that the future might be slightly less perfect than previously assumed can trigger an outsized reaction, even if the actual underlying business remains perfectly healthy by almost any historical standard. Let us zoom out for a second and think about the broader competitive landscape here, because this story is not just about Apple in isolation. It is also about the ongoing tug-of-war happening at the very top of the technology sector. Between Apple, Nvidia, and Microsoft, three companies that have essentially been trading the crown of most valuable company back and forth, like it is a game of hot potato that nobody actually wants to hold for too long, because whoever is sitting on top tends to attract the most scrutiny and the highest expectations. Nvidia's rise over the past couple of years has been fueled almost entirely by the artificial intelligence infrastructure boom, with demand for its chips absolutely exploding as companies around the world race to build out data centers capable of training and running increasingly powerful artificial intelligence models. Apple's path to the top, by contrast, has been a little more old-fashioned in some ways, built on the steady, reliable cash-generating machine of iPhone sales, combined with a services business that keeps quietly compounding in the background, like a diligent squirrel storing up nuts for the winter, except in this case, the nuts are billions of dollars in subscription revenue. Microsoft, meanwhile, has been playing both sides of this game, rather cleverly benefiting from its own artificial intelligence, investments, and partnerships, while also maintaining an incredibly steady and diversified business across cloud computing, enterprise software, and gaming. When you have three companies this large, this profitable, and this dominant, all competing for the exact same title, even small shifts in investor sentiment toward any one of them can cause the crown to change hands almost overnight, which is exactly what we witnessed with Apple's brief moment at the very top, before Nvidia presumably reclaimed its position shortly afterward. Now let us talk about what this whole saga might mean going forward, because as entertaining as this roller coaster has been to watch from the sidelines, there are some genuinely useful lessons buried in here for anyone trying to understand how markets actually function. The first lesson is about the danger of chasing headlines, rather than fundamentals. If you had bought Apple stock purely because you saw the headline about it crossing $5 trillion, purely riding the excitement and the momentum of that historic moment, you would have found yourself buying at almost exactly the peak, right before the stock proceeded, to give back a meaningful chunk of those gains within days. This is a pattern that repeats itself over and over again throughout stock market history, where the loudest, most celebratory headlines often arrive, right around the moment when a stock has gotten a little bit ahead of itself. The second lesson is about the outsized importance of forward guidance in how markets price stocks, especially for companies trading at premium valuations. Apple's actual quarterly results were not disastrous by any reasonable measure. The stock did not fall because the company suddenly stopped making money. It fell because the company's own outlook for what comes next introduced enough uncertainty to make investors nervous about whether the premium price they were paying for the stock was still justified. This is a dynamic worth remembering the next time you see a company report earnings that beat expectations on the surface, but the stock still somehow drops afterward. 9 times out of 10, if that happens, the culprit is sitting inside the guidance, not the headline numbers everyone glances at first. The third lesson, and honestly probably the most valuable one for long-term investors watching this unfold, is that even the largest, most dominant, most seemingly unstoppable companies in the world experience genuine volatility, and that volatility does not necessarily reflect any fundamental change in the underlying quality of the business. Apple is still Apple. It still has one of the strongest brand loyalties of any company on the planet. It still generates cash at an absolutely staggering rate, and it still has a services business that keeps growing quarter after quarter, a 7% pullback after a historic run. Higher is not necessarily a sign that something has fundamentally broken. Sometimes it is simply the market catching its breath after sprinting a little too enthusiastically in one direction. Let us have a little fun with this for a second, because I promised you this would not just be a dry recitation of percentages and market capitalization figures. Imagine Apple's stock chart as a really overconfident marathon runner who sprints way too fast in the first mile, convinced they are going to set a new world record high, fiving spectators along the route feeling absolutely invincible. And then, right around mile 2, reality sets in a little bit, the legs start burning, and the pace has to slow down, while the runner catches their breath and settles into something a little more sustainable for the actual length of the race. Nobody watching that runner slow down at mile 2 should assume they are about to collapse entirely. It is just the natural rhythm of running a race that lasts a lot longer than a single dramatic sprint. That is essentially what this whole $5 trillion milestone and subsequent pullback represents in the broader context of Apple's long-term story. The company sprinted ahead of itself a little bit, hit a genuinely historic number that will be remembered and referenced for years to come, regardless of what happens next, and then settled into a more sustainable pace after the market digested some slightly less rosy guidance about the road ahead. This does not mean the marathon is over. It just means the easy, exciting part of the sprint has given way to the harder, grindier middle miles, where actual execution matters more than pure momentum and excitement. It is also worth mentioning, because context always matters in stories like this, that this entire episode is playing out against a backdrop where the broader technology sector has been experiencing some genuine rotation and repositioning. We have talked on this channel before about how healthcare and financial stocks have been quietly climbing to fresh all-time highs, while some of the flashier technology and semiconductor names take a breather after enormous runs higher. Apple's wobble after its historic milestone fits neatly into that same broader narrative of a market that got a little bit ahead of itself in certain corners and is now working through a period of digestion and reassessment before potentially deciding where the next leg of the story actually goes. Let us talk for a moment about what analysts and investors will actually be watching closely in the weeks and months ahead, because this story is far from over. The supply constraints mentioned in that guidance report will be a key thing to monitor, since resolving those bottlenecks could quickly restore investor confidence. If the company demonstrates it can actually ramp up production to meet demand. On the flip side, if those constraints linger longer than expected, or if new problems pop up in the supply chain, that could keep pressure on the stock for a while longer. The services business also deserves close attention, since continued strong growth there would help reassure investors that Apple's profit margins remain on solid footing. Even if hardware sales face any near-term hiccups, there is also the broader question of how Apple's own artificial intelligence strategy continues to develop, since this remains one of the areas where investors seem the most uncertain about the company's competitive position relative to some of its biggest rivals. Whether Apple manages to convincingly demonstrate that its approach to integrating artificial intelligence into its devices and services can keep pace with what is happening elsewhere in the industry will likely play a meaningful role in determining whether the stock can reclaim its $5 trillion milestone in a more durable, sustainable fashion down the road, rather than just touching it briefly before retreating. I want to be very clear about something important before we wrap up this video, because it would be irresponsible not to mention it. Nothing in this video constitutes personalized financial advice. I do not know your individual financial situation, your risk tolerance, your investment timeline, or whether you already own shares of Apple, Nvidia, Microsoft, or literally any other company we have mentioned today. Please do your own research. Read the actual earnings reports and analyst commentary yourself, and consider speaking with a qualified financial professional before making any investment decisions based on anything discussed in this video, or honestly in any video you watch on the internet, including the ones with the dramatic music, and the guy shouting about stocks like he is calling a boxing match. So where does this leave us as we wrap things up today? Apple briefly touched a milestone that no company has ever reached before in the history of the stock market, dethroning Nvidia for a moment at the very top of the corporate mountain, only to see a chunk of those gains evaporate within days, after delivering guidance that fell short of what investors were hoping to hear. It is a story with genuine highs, genuine lows, and a whole lot of lessons buried inside about how markets price expectations, how quickly sentiment can shift, even for the largest companies in the world, and why forward-looking guidance often matters just as much as the actual results, sitting right in front of everyone. None of this means Apple is somehow in trouble, and none of this means the $5 trillion milestone was some kind of fluke. That will never happen again. It simply means that even the biggest, most dominant companies on the planet are not immune to the emotional whiplash that comes with operating in a market that constantly recalibrates its expectations based on the smallest shifts in tone during an earnings call. If anything, this entire episode is a fantastic reminder that market milestones, however historic and however exciting they might feel in the moment, are just single data points along a much longer and much bumpier journey. If you enjoyed this breakdown, go ahead and smash that like button, because it genuinely helps this channel reach more people who are trying to actually understand what is happening in these markets, rather than just reacting to whatever scary or exciting headline happens to be trending on a given day. And if you have not subscribed yet, now is a great time to do it, because we are covering stories exactly like this one every single week, breaking down the drama, connecting the dots, and trying to make all of this genuinely entertaining, rather than something that feels like homework you have been putting off since last Tuesday. Drop a comment down below and let us know what you think happens next for Apple. Do you think the stock quickly reclaims that $5 trillion milestone once supply constraints get resolved? Or do you think this is the start of a longer stretch of consolidation while the market figures out exactly how to price the next chapter of the company's growth story? I read through the comments regularly, and some of the sharpest takes on this entire channel come directly from those discussions, so do not be shy about jumping in there. Before you go, if you found this video useful, consider checking out some of our other recent breakdowns, including our look at the broader rotation happening between technology stocks and more defensive sectors, like healthcare and financials, as well as our deep dive into what exactly is going on with Nvidia and the ongoing artificial intelligence infrastructure boom that has reshaped the entire technology sector over the past couple of years. There is a whole lot of interconnected story happening across these different threads, and once you start pulling on one of them, you quickly realize just how tangled and fascinating this whole market actually is, once you look past the surface-level headlines. Thank you so much for watching all the way through to the end today. Stay curious, stay diversified, keep questioning the headlines, rather than just reacting to them, and we will see you in the very next video.